Our next guest has 5 oil stock ideas in exploration and production as we kick off Q2. Joining us this morning, Goldman Sachs Managing Director Neil Mehta. Neil, it's good to have you. Interesting conversation lately regarding the underlying commodity, but I know more targeted, you have some ideas in Canadian oils, right?
Yeah, Carl, we're continue to be very constructive on the Canadian oil complex. We're going to need oil for a long time. When we do our long-term oil demand modeling, we don't see a peak happening this decade. We think that peak happens at some point next decade, at which point we think the market needs to better appreciate companies with depth of inventory. And Canadian oils have that. In addition to a strong long-term reserve life, they generate a lot of free cash flow in the here and now. In 2025, we've got Canadian oils trading at 11% free cash flow yields. The typical large cap energy stock trades at an 8% free cash flow yield. So whether it's companies like Canadian Natural Resources, Suncor, Cenovus, Canadian oils, we think are an interesting place for investors to engage.
As for the majors, Conoco is interesting to you, and then you've got some thoughts as well on refiners.
Yeah, thanks, Carl. So on ConocoPhillips, the stock has done well over the last 5 years. They've done some transformative acquisitions, whether it was Concho or the Shell Permian position that has really set up premium returns on capital. You've got a company that's going to generate over the next 5 years, average ROCEs north of 20%. The market is concerned about 2 growth projects. The first one is up in Alaska, the Willow Project, and the second one is on the U.S. Gulf Coast, the Port Arthur LNG project. But even as we evaluate both of these projects, we think that they're going to be additive to the portfolio, but the execution that this company should be able to deliver over the next couple of years is certainly much better than the valuation gives it full credit for. We also continue to underwrite the leadership of the business under Ryan Lance, who's transformed the business from one that had a share of issues from the 2014 to 16 period to one that's really on the front foot.
I mean, so much on these names just depends on what happens to oil, and I think prices surprised everybody in the first quarter by going up so much. Is it going to continue to be a supply-driven story, and what do you expect OPEC to do?
Yeah, the strength in Brent prices have really been a function of 3 dynamics. The first is U.S. production has taken a dip. It's gone from 13.3 million barrels a day at the end of last year to 13.1 million barrels a day now. We would expect that to recover, Sarah, over the course of the year, but it's certainly been a little softer than someone would have expected. The second is Russia production has come in a little bit softer than expected as well. It's been a while since those sanctions were put in place, but we're starting to see some bite, and the disruptions in Ukraine from a refining perspective have also moved upstream into the production levels. And the third and most important piece is demand. Most oil watchers would have expected oil demand to be trending closer to 1 million barrels a day this year. It's trending closer to 1.5 million barrels a day. And while China's been softer, India, Europe, and Southeast Asia have all been sources of surprise. As we look out over the medium term, because as an equity analyst, what we really care about is the medium-term oil price. We continue to embed $80 to $85 Brent. The forward curve as a swap between now and the end of the decade is closer to $75 Brent. So we see an opportunity for the oil price to continue to roll up as people better appreciate we're going to need this commodity for a long time. And as non-OPEC supply is finally eclipsed by the growth in demand as shale starts to mature.
You think the market is effectively pricing in a would-be China recovery?
I think the market is starting to better appreciate that the demand picture is going to be above consensus. Again, IEA a year ago was 0.8 million barrels a day. Today, they're low ones. Ultimately, we think the demand growth in millions of barrels a day is going to be close to 1.5. There's no doubt, Carl, China is coming in softer than expected. But when we look at what's happening in Europe, when we look at what's happening in India, when we look at what's happening in Southeast Asia, those are more than surprising and lead us to have an above consensus view of demand, which should be supportive for price. Again, we're not of the super spike view. We're not of the view that oil prices are going to race to the right, up and to the right. But we do believe in the duration of the oil cycle. The typical oil cycle, if you go back to the 1970s or even if you go back to the 1860s, has lasted over a decade. So to us, it feels like we're still in year 3 of a higher for longer environment.
Yeah.